Today we want to focus a little bit on the CRD, CRR, the Banking Prudential Framework.
We have put forward on the 28th of April a package, a banking package. In a second step, we have presented in July our capital markets recovery package.
The ability to get the CRR quick fix in particular through the co-decision process as quickly as it was and adopted was sort of more important than any of the details that we might have felt were missed. Software capital deductions, which is one of, from our perspective, the most important elements of that quick fix. There are already discussions at the Basel level around operation of capital buffers and what's worked and what hasn't. And I think it's important we do take away lessons from the experience of this year and beyond. I think there are also other areas where we've seen perhaps unexpected headwinds, the way in which the single resolution fund contributions have inflated fairly dramatically in the past couple of years.
The quick fix, the CRR quick fix was obviously very welcome. It is the exit strategy in a situation which will become, in my view, more and more difficult. I would say it's not enough. I mean, we desperately need a true relaunch of the securitization.
How do you view the SSM's response in this context? Particularly, I mean, there was the debate about dividend restrictions, for example.
Supervisors seem to not understand that we are still in an open economy where international investors have the choice.
The issue of uncertainty, lack of clarity around how European banks are going to be treated and the flexibility that they will have to deploy, bank-specific discretion in payment of dividends and also behind that remuneration. That shadow of uncertainty is not helpful.
There are two, I wouldn't say, I shouldn't say positive, but factors that contributed to this harmonized international coordination. One was this crisis did not come from financial sector. And the other factor was this was simultaneous. But I think exit, there will be time difference. One thing that I think was very influential and effective was the leverage ratio exposure calculation. I think what would be challenging for all of us going forward will be if jurisdictions start tweaking here and there and diverge from the Basel standard. I think that will create a huge number one, it's source of fragmentation, level playing field issue, but also that could undermine the Basel framework. But at least the timeline, the framework should be respected, and that should be implemented in all jurisdictions on a timely manner.
I think it makes some sense to pause further and to wait until we really do have a clarity around the overall impact of the pandemic before necessarily pushing ahead with implementation. We shouldn't be afraid of revisiting the Basel framework now that we've got some real world data to help us understand what works and what doesn't in practice.
I think it's interesting the point you and Dominique have made about the, what I call tension or the dynamic between market expectations and investors on the one hand and the prudential framework on the other.
There is no emergency to increase the capital of banks today.
No one is going to contest the fact that the banks have been able to withstand this shock thanks to the measures which were adopted after the last crisis. We have requested the European Banking Authority to proceed with a new technical advice in order to allow us to look into the impact of the fix on the situation of banks and look into the impact, of course, of the crisis on the situation of banks. I fully agree with the issue of avoiding fragmentation, that's extremely important, and of keeping international coordination ongoing. In our preparation of the Basel III implementation, whilst being committed to Basel III implementation and wanting to be faithful to Basel III implementation, we cannot exclude some targeted minor adaptations because we need to remain faithful to the European specificities to preserve or ensure the level playing field for our banks internationally.
This unwinding of prudential measures should go hand in hand with the government assistance, the fiscal policy, also the monetary policies.
Then we're going to need to make sure that we have in place functioning securitization market, and that's a big ask politically. We also need to look at the prudential incentives around NPLs.